Hold on to your hats, folks, because oil prices are taking a wild ride, with experts predicting an impending recession and a crisis of confidence in our banking system. Oil prices have dropped a whopping 17% since the beginning of March, down to $67 per barrel. Natural gas? That's down 50% since December, and those poor oil companies have seen their shares plummet by around 20% in recent weeks. Now, if you're not like the big dogs at Berkshire Hathaway, there are some cheaper options out there. Some data shows that the average independent oil producer trades at around 11 times earnings. Some of the best bargains seem to be Northern Oil and Gas with a PE of 3, and Diamondback Energy at 6.8 times, meaning that their share price is 6.8 times its earnings, making it a relatively cheap investment compared to the average independent oil producer, which trades at around 11 times its earnings. Score. But okay, let's not forget about where we were in 2020 when the pandemic had us all singing the oil industry blues. Thankfully, things have improved since then, with companies cutting costs and managing their debt down to a reasonable 25% of capitalization. Some people estimate that the average company needs oil prices to hover around $54 per barrel to break even after accounting for dividends and capital investment. Looking for some exciting news up north, Suncor Energy is trading at 8 times earnings and 4 times cash flow with a dividend yield of 5.3%. They pump a solid 750,000 barrels per day and have been in talks with activist investor Elliott Management to make some management changes and improve safety after a tragic loss of 5 workers since 2020. If that's not your cup of tea, Canadian Natural Resources and Cenovus Energy are looking nearly as enticing. Now, some folks over at THP and Company are telling us that the energy sector's uncertainty is actually a global opportunity. They're expecting China to add 1 million barrels per day to demand and India to increase by 250,000 barrels per day this year. With Iran still on the bench and Russia's output predicted to drop by 500,000 barrels, they foresee tighter oil markets down the line. And with oil prices now at his target level, there's one guy who should be buying oil like there's no tomorrow: President Joe Biden. He's already sold over 250 million barrels from the Strategic Petroleum Reserve, which he promised to refill when prices dip below $70. Time to stock up, Mr. President. On the other hand, supplies are abundant. We're witnessing the aftermath of a 40% surge in oil field capital spending from last year's sky-high oil prices. Domestic oil production is set to grow by 500,000 barrels per day to 12.9 million this year, and even Russia is keeping up at 11.3 million barrels per day. So, is it time to be brave or to panic? Goldman Sachs analyst Dave Struven and his team think the oil market is being too pessimistic. They've lowered their 12-month price target to $94 per barrel from $100, but even that's higher than where we're at today. Warren Buffett seems to agree. He recently snapped up another 13 million shares in Occidental for nearly $800 million, taking Berkshire Hathaway's equity stake in Oxy to 23% and a cool $12.5 billion. Buffett may not have a crystal ball, but he knows the power of fossil fuels in diversifying Berkshire's long-term health, especially in light of those pesky federal government deficits. So, are you ready to take the plunge into oil stocks? The choice is yours, but remember, it's a wild ride out there.